Ladies and gentlemen, I welcome you all to the Q4 and FY24 post-earnings conference call of Royal Orchid Hotels Limited. Today on the call from the management, we have with us Mr. Chandar K. Balji, Chairman and Managing Director, Mr. Philip Logan, Chief Operating Officer, Mr. Amit Jaiswal, Chief Financial Officer, and we also have with us for the first time Mr. Arjun Balji. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risks and uncertainties. Also a reminder that this call is being recorded. I would now request the management to detail us about the business and performance highlights for the quarter and the year that went by, and the growth plans and vision for the coming year, post which we will open the floor for Q&A. Over to you, sir.
Good afternoon and a warm welcome to everyone. Thank you for joining us for the Royal Orchid Hotels Limited earnings conference call for the fourth quarter and annual results for the financial year 23-24. Please note that Q4 24 and the annual results, press release and investment presentation are available on the exchanges. I hope you've had the opportunity to browse through the highlights of the performance. In this financial year, we have seen good business, which is evidenced from the financial results of this quarter and for the whole financial year 23-24. In fact, we have built on the success and have added 3 hotels with 131 keys in Q4 24, and we have added 1,170 keys since April 23. The company is growing with a strong business model, mix of owned and leased hotels and managed hotels, and effective risk mitigation strategies. We are working to post better margins than what our company has witnessed in the recent past. Financial highlights for the company of the fourth quarter and for the year ended 31st March 24 on a standalone basis are as follows. Standalone income for 23-24 was 198.29 crores as compared to 176.62 crores in 22-23, a growth of 12%. Standalone EBITDA for 23-24 was 63.05 crores as compared to 61.85 crores in 22-23, an increase of 2%. Standalone PAT before exceptional items for 23-24 stood at 24.62 crores as compared to 28.17 crores in 23-24, a decrease of 13%. Consolidated income for 23-24 was 312.7 crores as compared to 279.6 crores in 22-23, a growth of 12%. Consolidated EBITDA for 23-24 was 95.16 crores as compared to 98.3 crores, a decrease of 3%. Consolidated PAT for 23-24 stood at 50.83 crores as compared to 49.23 crores in 22-23, an increase of 3%. I would like to highlight certain points before I give the explanation for our performance. The return on capital employed for the year 23-24 stands at 20%, which is one of the highest in the industry. The company has reported an increase of consolidated PAT by 27% for the Q4 in comparison to Q4 of last financial year. The company has also got tax benefit from the acquisition of 100% stake in Icon Hospitality at a cost of 34 crores. This resulted in reducing the overall tax cost of the company by getting a deferred tax asset. The company's EPS remains strong at 17.68 per share, and there's a reduction in the consolidated debt by 29%. Royal Orchid is a dividend-paying company. In the current year, we have proposed a final dividend of 25%. The company has added 1,057 rooms under management and 113 rooms under revenue share in the last financial year. We will add approximately 1,500 rooms under management and 400 rooms under revenue share lease in the current financial year. Now I understand that you must be thinking that while the consolidated income of company has grown by 12%, but why the consolidated EBITDA has decreased by 3% and PAT has grown only by 3%. As you see, the company is growing. Hence, to support the above growth, the company was required to increase its bandwidth of operation, for which it is required to increase its workforce in different regions, which the company did. The cost of the above started immediately, whereas revenue for the same will come in times to come. For this, the company incurred an additional cost of 2.05 crores. This is a prime reason for cost escalation, which should be seen as investment for future growth. In the last 4 years, the company's assets could not be maintained, refurbished due to COVID and uncertainty which followed looming around the industry. Since the company had did good revenues and profit in the financial year 22-23, hence the company took up the same in the current year and started refurbishment required in the phased manner to maintain standards which cannot be called capex in nature. The same resulted in a double hit, a reduction in occupancy due to approximately we lost about 2.2 crore and increase in the repair and maintenance cost of 2.31 crore. But the same was necessary to remain in competition. If you see the slide number 27 of the investors presentation, we have given workings of the Ind AS calculations. You will find that our profit without Ind AS adjustment are 56.73 crore instead of 50.83 crores with Ind AS adjustments. These Ind AS adjustments need to be done as per accounting standards. However, they are not cash in nature. Hence, you will find that the company has got a very good cash profits. The management set out a strategy to diversify its product offering, provide unique customer experience, and work towards a robust balance sheet. I would like to conclude my opening remarks by saying that the company is doing very well, and in the long run, we will be a company to reckon with. We will be opening a new hotel with 300 rooms in Mumbai during the year, as we are looking to get new hotels under revenue share. We have a strong, good capital deployment strategy, which will make our company very strong, and we will produce very good financial results as we move ahead during the current financial year. Thank you. And now we can throw the floor open for questions.
Sure, sir. All those who wish to ask a question may use the option of raise hand. In case there's a problem at your end, you can put the question in the chat or putting a request in the chat, and we'll invite you to ask your question. So we'll just wait for the question queue to assemble. We'll take the first question from Rahul Bangadia. Rahul, you can go ahead, please.
Thank you for taking my question, sir. You already kind of laid out the answers for some of the questions that we had within the presentation, and I'm really happy that you have kind of put out some more data also in the presentation. It helps us get some perspective on ARRs and occupancies. Given that data and the explanation that you just gave out, on the repair capex, which is not necessarily a capex but had to go through the P&L, all of those numbers were in a particular quarter, sir, or broadly spread out through the year? I'm asking this because this particular discussion probably also happened in the Q1 or Q2 call. So I'm just trying to understand whether this was spread out or concentrated in 1 or 2 quarters.
Rahul, it was primarily spread out. It started sometime in Q2.
Okay.
And it has continued in Q4 also.
So this roughly 2.5 crore hit on the revenue and 2.5 crore hit on the cost line because of the repairs has got distributed over the year, essentially.
Yes, and also the increase in the employee costs also.
But that would have been more to do with the future growth that we want, right?
No, but the cost is coming in the P&L right now.
That is sure. That is okay.
So basically, our cost has gone up to that extent. The revenues have got hit.
Okay.
Sorry.
And would that be the primary reason, sir, why your Bangalore ka occupancy this year is lower than FY23?
Little lower as compared to earlier years, because some of the Bangalore hotels we have been, doing the refurbishment, getting some rooms down and not selling. That's why the occupancies have got hit.
Because we are seeing FY23 was 76%, now we are 69%. So that's a reasonable 10% drop in the occupancy itself.
Yes.
And that is entirely due to the refurbishment is what you're saying.
Yeah.
So now, if you could give us a sense of what will be the steady state margins we are talking about, because as you said, we've incurred this cost. Are we through with these refurbishments, sir? Is that something that we can take away?
No, some is still pending. Because see, you know what happens in a running hotel if you have to do refurbishment, it is a little difficult and time consuming job. Which cannot be done immediately. Like in our Mysore hotel, we are doing it three rooms at a time.
Okay.
Similarly, in our flagship also, we are doing few rooms, like 10 rooms at a time. You cannot close down the hotel. So it's going on. It's some part will come in the current year also. But we are seeing a growth in the ARRs as such. And the occupancy in the current year may not be hit that much. Maybe, a couple of percentages it will get hit.
Okay. So we are left with some part of it. So let's say last year we ended up incurring this full cost of about 7-8 crores. This year we'll have another 2-3 crore hit? Or
Yes, absolutely.
Okay. And so coming back to the basic question of what is incurring for all this cost and all, maybe some nature one-off, what is the EBITDA margin if accounting for Ind AS we are looking for? Last year we were in that 35 to 38% range. This year we are much lower. So what is it that we are looking for, both in terms of top line growth this year and the margins that we are looking for?
See, in the current year there will be a growth as far as the top line is concerned. So we are looking at somewhere around 370 to 380 crores in the current year, the top line growth. And EBITDA growth will be around, 10 to 15 crores of EBITDA.
Okay, so this year also then it looks like the cost structures will be growing faster than the top line.
A little, it will be affected. But 25-26 will be definitely very good.
And what would be the primary driver of this the cost increasing higher than the revenue? Because some part of the employee cost would have already accounted for it.
No, most part of the employee cost has been accounted, but we will incur certain R&M costs. See, Rahul, that last 4 years we have not touched any of our hotel posts since COVID started in 2019-20. So we need to, next 5-6 years, if I have to run the hotel and be competitive in the market, we'll have to do, all the hotels in phased manner. So that is why I'm.
Okay.
Rahul, if I could just add, if you look at opening a hotel, let's say we open Mumbai hypothetically towards the end of this year, you will start hiring, a full team towards the middle of this year. So you will have between 3 and 6 months of a ramp up of the team. Right, and you'll have at least 3 months with no revenue, right? That's so that these are kind of taken as startup costs towards the hotel, and then from day one, the hotel isn't going to be at the desired level of occupancy. Hence, what as Mr. Jaiswal was saying, that
24-25 is when, no, 25-26 is when you'll see, the impact of, say, the Mumbai asset. And I'm just limiting my discussion right now, the answer just to Mumbai, to give you the example. So that is a significant revenue driver that we have currently. And, it will kind of be a flagship of sorts. But 25-26, you'll see that hotel's performance come in, where all the costs, right, will be stabilized by the time that hotel actually starts producing the numbers that it needs to.
Okay. Just one more before I come back to the queue. If you could give us a sense of this exact Mumbai hotel, what are the dynamics here? What is the deal that gets signed? What is the top line that we're looking from here in a steady state?
See, the top line would be anywhere between 100 to 120 crores that we are envisaging. And as far as, dynamics is concerned, it is, we have to pay a monthly rental, which is more or less fixed for 5 years. Okay. Of, the annual rent would be around 36 CR.
Okay.
So we definitely make, money there.
And this 120 crore top line will be at what? 75% occupancy, 75% occupancy?
80% occupancy.
80% occupancy.
If it is 75%, we will do around 105 to 110. If it touches 80%, we will do 120 CR. That's how the scenario will be.
Okay.
But Bombay, most of the hotel does well, above 75% occupancy. So we are hopeful that we should be doing above 70% occupancy.
And besides this rental, sir, what are the costs that we are kind of going to take up on our books besides the rental?
See, it will be only, the rental cost plus maybe a little bit of finance cost may come, 2-3 crores of finance cost will come. Otherwise, there is no much investment.
So the management cost has been taken up by the owner?
No, it's not management. It is on rent, no? So the entire...
that's why I asked. Since the hotel running itself will need people and power and everything else, that's why I asked.
Right. And that's exactly what we're saying, that the P&L of the Mumbai hotel, right, the P&L belongs to us, right? We will pay rent to the landlord for the shell in the building.
Right.
The asset will open towards the end of this calendar year.
Okay.
Right? And hence, as I had said earlier, that starting, works are already on at full swing. And starting the middle of this year, we will start hiring people, and start incurring operating costs. Hence, what Mr. Jaiswal had said that, we will see a little pressure on the cost side, going to your statement of cost outpacing revenue, because the revenue is yet to come, right? But that hotel in itself is, if you're looking at between 100 and 120 crore top line, that should be in our books 25-26.
And just to further that, in isolation, we're talking about the hotel in isolation. I think it can't be understated by opening a 300-room hotel at T2 Mumbai. The billboard effect of that hotel will give recognition to the brand on a greater perspective. So it's important to see a standalone, but it's important to understand while there will be cost in the front, but also the benefit will be that people walking out of the airport will know that's Royal Orchid. And
sure,
that can't be understated.
Yeah, my question was more related to, besides the 36 crore cost, what are you expecting? Let's say 120 crores, you have 36 to de doge. What is the other cost? So what is the EBITDA or the operating profits that you are expecting at the site level is what I was asking.
See, we will be getting an, EBITDA of around 15 to 20 crores. The operating margins will be somewhere around 50%. And when this cost goes, so around 20 crores, 15, 20 crores, so definitely will make.
15, 20 crores of...
For the whole year. For the whole year, yeah.
For the whole year of operation at the site, at that site. Great, sir. Thank you very much. I'll come back.
Thanks, Rahul. We'll take the next question from Sakshi Chhabra. Sakshi, you can go ahead.
Yeah. Hi. So my first question was, I wanted to just understand that the occupancy in the Mumbai segment also was down to 68% from 79% last year. So what was the reason for that?
So, Sakshi, I think, as I had said earlier, that, we will see a little pressure on the cost side, going to your statement of cost outpacing revenue, because the revenue is yet to come, right? But that hotel in itself is,
No, you see what we have given in our presentation, the Mumbai, that is primarily our Navi Mumbai hotel, one Navi Mumbai hotel only, that numbers are there. Because right now we don't have our own JLO hotel in Mumbai. It's under management. So there, that hotel also was under renovation in last year. Some part of it had gone in renovation.
Okay.
That's why the occupancy was down.
Okay.
But the entire number doesn't hit our PN.
Sure. So, my second question was that whenever we do refurbishments, like now especially in the Bangalore hotel, so to what extent do you think we will be able to increase the ARR?
No, see, this refurbishment may not give us an increase in the ARR because we are not spending heavy capex. It's not that we are breaking down the room and doing it. We are just doing a spruce up of the hotel. Maybe, like the changing the little bit of maybe television, painting, polishing, uplifting the bed, those kind of very light expenses. Because if I go for renovation, then it will cost a lot of capex for us.
All right. Okay. And the new Mumbai hotel that we would be opening, so what is the range of the ARR you are expecting over there?
We are looking at an ARR of anywhere between 8 to 9,000 rupees.
8 to 9,000. Okay. All right. Thank you. That's it so much.
Thank you, Sakshi. We'll take the next question from Rishit. Rishit, you can go ahead.
Yeah, thank you for the opportunity and good afternoon, sir. So, dwelling a little deeper on the renovation of the refurbishment part. So, when we say we incurred an expense of around 2.2 CR, that just a clarity, if that is for the quarter or for the full year?
No, that is for the full year, not for the quarter.
Full year, okay. So, if you can help me with the count of the rooms that would have been refurbished over here?
Roughly around, around 100 rooms we would have done.
100 rooms. And what would be the average kind of period that is required to refurbish the room? So,
one room if we take, it takes at least 10 days to do a little bit spruce up.
Okay, so that's not a major hit on the occupancy.
No, it gets hit. No, see, 10 hotels, 10 rooms are taken and it is not there for 15, 20 days. So the occupancy definitely gets hit.
Right. And a similar kind of number we are expecting for FY2025 as well, correct?
Somewhat.
Okay.
Somewhat.
And lastly, so we have kind of seen heavy additions in the 5-star space of late, and it is in line with what we had envisaged also. So any further, any strategy to concentrate more on that space, or we'll kind of be spread out across 4 stars, 3 stars, and 5 stars?
So the major expansion will be in the mid-market space, but yes, this hotel in Mumbai will be 5-star. Hotel in Bangalore is 5-star. Then we got Jaipur Hotel and Goa Hotel, which are 5-star. And there are 2 managed hotels which are 5-star. One is in Western Ghats, Belagavi, and one is in Ambala. So wherever there is a possibility, we will take that. And we are in discussion with 1 or 2 other properties also, which will become 5-star with a little bit of upgradation and all that. So I think they will be a gradual, but the major thrust is 4-star and 3-star. That will be the major thrust even in future.
Right, got it, sir. I'll fall back to the queue. Thanks for the answers. Thank you.
Thanks, Rishit. We'll take the next question from Kishori. Kishori, you can go ahead, please.
Quite detailed and comprehensive this time. So I would like to congratulate you for the efforts taken in the preparation and transparency in presenting the data points. My first question is, once the key hotels are back to full working condition, post renovation, what will the company level ARR and RevPAR move towards?
See, if you really look at our ARR, okay, I would like to see our slide which we have given. So we have done an ARR of 5,673 as far as the JLO hotels whose numbers get consolidated. Okay, and last year our ARR was 5,370. Okay, so there is a growth of almost 300 rupees, which is around 6-7%. So it has grown. So in the current year also, we are looking at growing the ARR by around 5%, 4 to 5% in the current year also.
Yeah. Anything? Hello. My second question is, anything formed up on the new brand name under which your new 5-star hotels will be launched?
See, we are actively working on the brand architecture, and because we have grown so rapidly that people are sometimes getting confused between the sub-brands. See, we have Regenta Central, Regenta Place, Regenta Inn. So there's a little confusion there in the mind of the customer. So for the 5-star hotels, there's going to be a new brand which will be launched once a Bombay hotel opens. So we'll be launching it with a new brand. And we are also looking at a brand in the smart basic category, which will eventually, we won't call it a budget hotel, but it'll be a really catering to the millennial crowd who are very tech savvy. They want a minimalistic decor, but everything very convenient, So that is also being launched. So these two things will happen this year.
Okay, sir. My third question would be, what will be the Ind AS impact on depreciation and interest in FY25 and FY26 post Mumbai hotel coming up?
Exactly that, Kishori. We are also looking at the Ind AS impact. There will be definitely Ind AS impact, but right now it is very difficult to calculate because it all depends when the hotels open. Till the hotel is not opening, it is very difficult to calculate the Ind AS impact. However, in coming quarters, we will be definitely giving a guidance as far as the impact of Ind AS is concerned. But if you really look at it, the company is doing good cash profit, okay, and it will continue to do.
Yes, sir.
Thank you, Kishori. We'll take the next question from Chirag Singhal. Chirag, you can go ahead, please. Chirag?
Am I audible?
Yes.
Yes.
Hello, am I audible?
Yeah, Chirag, you can go ahead.
Yeah, I just had one question regarding the refurbishments. So you have mentioned that there was a revenue hit to the tune of 2.2 crores. Then there was an increase in employee expense of 2 crores and repair and maintenance of 2.3 crores. So employee benefit and repair and maintenance is understood. So what was the loss of profitability? So as far as I can see, there will be two types of hit to the bottom line, right? First will be the loss of profitability and second will be the expense, which is kind of a one-off during the year. So 4.3 odd crores is the expense, which would have hit the profitability. What was the loss of profitability because you lost some revenues during the quarter?
See, any refurbishment when you do, that room is not available to be sold. So it hits the occupancies immediately and it results in decline of the revenue. What revenue we would have done, it has declined partially to that extent. Plus, the expense what we do for the refurbishment, it hits the P&L. So there is a double hit always because of this. And that is why you are seeing, the cost has gone up and profit margins have come down a bit.
See, example, in Mysore, we've taken up the renovation of our Metropole Hotel. So in April, we blocked 8 rooms out of 30 rooms for renovation renovation. And the rooms are now ready. As of today, the rooms have been released. So the revenue will start today, but last 3 months, we have lost revenue, plus the cost we've incurred on renovation. So this way, depending on the situation, we decide the timing of the renovation. That means then there's a little dip or so. But irrespective of that, some revenue hit will come, and the cost, in any case, will come.
Understood. Okay. So broadly, just to reconfirm, 4.5 odd crores is what was direct hit to the profitability, because there was some increase in employee expense as well as there was some repair and maintenance, and then there was some loss of profitability on the 2.2 crores of revenue that you lost.
You are right. You are right.
Okay, and just wanted to reconfirm on the guidance for FY25. So for FY25, how much such refurbishment expense you are seeing?
See, FY25 right now telling is very difficult, because as and when it comes, but however, there will be some refurbishment cost in FY25 also, and not capex. I'm talking of refurbishment and not capex. Somewhere around 2 to 3 crores it will come.
Okay, understood. Thanks. That would be it from my end.
Thanks, Chirag. We'll take one person from the chat box, Mr. Yash Dantewadia. You can unmute and ask your questions.
Yeah, hi. So just wanted an update on the capex, Goa and Bangalore, which you said will be done by March 25. Can you also give some understanding on the multi-hotel sale? And also, what is the PBT guidance for this financial year? Would you be able to give that with the Bombay impact that you're saying will come, right? Because your cost will go up, revenue won't show up. And the Goa and the Bangalore capex, that is the proper capex, right? So that's also going to impact the numbers. So could you just give a PBT guidance for PBT? I don't want the EBITDA, I want the PBT guidance for FY25.
See, as far as capex of Goa and Bangalore one is concerned, that is not going to hit our P&L. Definitely they will get capitalized, because we are adding additional, facility in the hotel. Goa, it may not come this year, it may come next year. However, the Bangalore one, definitely additional 28 rooms will be added. That will come here. It's not going to hit the P&L. So that is, as far as the PBT guidance is concerned, let me tell you, a big number depends on the opening of the Mumbai hotel. Okay. So if the hotel starts operations from 1st of January, we are hoping, but works, how the project work goes, there are a host of factors on which it depends. However, if it comes in the first week of January, so we are looking at a PBT, a growth of roughly 15% on the PBT.
Yeah, so this Goa capex is basically getting delayed. Is that what you're saying?
Yes, it may get delayed because still we have not got the plan sanction. So once the plan sanction comes, then only the work we will start the work. And suppose if the plan sanction comes immediately in a month's time, we may start. And suppose if the plan sanction comes sometime in the mid of September, October, then we might like to, we'll take a call then and there, the committee will take a call. But we might like to delay it for 3-4 months, because Goa, the peak season is November, December, Jan.
Also, what I understand is corporate spending went down, right, in Q4 overall. So how do you see this coming back post-elections? Do you see a comeback in corporate spending? Because I do know that a lot of corporate meetings got delayed to post-elections. So could you talk about Q2? Q1 I know is now going to be great from what I understand. But could you talk more about Q2? And do you think corporate spending is going to come back? Because I'm sure you're having a lot of conversation with corporate companies, right?
Yes, corporate companies, we are hoping that after the elections, it will definitely come back. So second quarter, a lot of corporate bookings, we are already have started seeing it. Basically the postponement of all the meetings which were scheduled in April and May, Because of the election, they have got postponed. So from Q2 onwards, we will see the change and, the increase in the occupancies.
It's been not specific to one sector. Pharma, banking, agri, IT have been the corporate segments that have been largely affected in this first quarter related to election and other activity. But certainly forward group bookings are suggesting that it's going to be pent-up demand. So Q2, you'll see corporate travel coming back, and definitely from those four segments.
How do you see the ARR trend for the rest of the financial year?
Generally the ARRs increases in third and fourth quarter. This year we got hit little bit in the month of March because of the elections announced and planned and all those things. But this year we see a growth in the ARR by 4-5% definitely.
Right. Also, you were talking about smart hotels, right? Could you tell me if that's something you would invest in, or would that be something you would manage? Because that's something I really want to understand. Because I really think the aggression of the company has gone down quite significantly, right? That's what the managed property suggests. But I'm hoping with the management team growing, right? I mean, the new person, I think Sanjay Balji's son has come into the board too. So, are we going to see some aggression coming back on the owned property side of Royal Orchid in the smart category?
Mr. Yes, both sons of Mr. Chandra Balji, Mr. Arjun Balji is here in physical. He is sitting here with us, and also his second son, Mr. Keshav Balji, also is there on the call. So I would like both of them to kindly speak up.
Yeah. That would be great to hear from them.
Yeah.
Yes, Arjun here. If we look at where we're spending money today, the company's funds are going predominantly towards the larger assets, be it Mumbai or a couple of more hotels that are in the higher category, right? Where the return on capital that we are measuring ourselves with, the return on capital employed will be very high, right? That's kind of the metric that we're looking at, where we spend the dollar. As far as the smart hotel and the high growth category is concerned, we've got a bunch of hotels in our portfolio that are in the 3-ish star space, which can easily be bucketed into a new brand, and that then has a life of its own, if I want to put it that way, right? But what we're currently defining is that how is that hotel product different from anything out there, right? How are we going to redefine the lower the value price category per se, right? In order to cater to the younger demographic of the country. It's not necessarily business. It is business, leisure, whatever that may be. It's the say the 25 to 40 traveler. How do you create a new, smarter concept for them? There are ideas. There are some test cases that we're in the middle of doing. There's a lot of technology that's going in, and we'll have a working prototype fairly soon. And then it's a question of conversions of a vast number of the hotels we have, so that the kind of costs come down, the revenues go up, and we'll see how we can grow that through a management I think a management route would kind of be the best way to go.
We are also looking at the Gurgaon hotel as a smart. So we are working toward that. A lot of brand architecture is being done. So these are all work in progress right now. I think maybe by the next quarter we'll have more clarity, and we'll give you more clarity on that.
Mr. Keshav Balji, would like to speak?
Yeah, sure. I'm audible, Amit?
Yes.
Okay, wonderful. No, I think just answering the question on aggression, I think in terms of management contracts, definitely we've been very aggressive, and we have added a record number of rooms in the last couple of years. If you look at what we were pre-pandemic to what we are now, there's a sea change. We've crossed over 100 hotels. That is a good time for us to stop and pause and also look and see, what is the mix that we want for, a good growth going forward. So what happens is we now have a good fee-based income coming because of management contracts. And this is going to stand us in good stead even in downturns in the future. So that allows us to build a lot of resilience into our business model. And the second part about it also is that, we do have a reasonable pipeline of revenue share come lease hotels coming up, which will add to the top line. And I think, the point is, not lost on all of us that this is a good time for us to capitalize on the fact that we have built out the rails from a management perspective. So it's a good time for us to also capitalize and take more properties, provided that they are suiting our brand and then they are also, remunerative as well. So I think we don't want to be overly aggressive and take any undue risks. But I think we are being, not cautious, but we are being reasonably aggressive when it comes to growing the brand. I think in the coming quarters, as these new properties, which have already been outlined, open up, you'll find that the revenue the top line will also grow, in a meaningful fashion. Thank you.
So, so just a follow-up on that.
Sure.
Basically, let's say in the next 2 years, you're managing / revenue sharing / owning approximately 150 properties, right? So your understanding of ARRs, geographies, RevPAR, occupancies, everything will grow significantly because you'll have a lot of data to act on, right? So will you be able to use this data and try to build the own property thing again, like own property space? Because that's what other companies are doing, right? Like Lemon Tree, they're using the data of understanding by managing properties, by leasing properties, and they're trying to build their own properties to where they see a high ROCE generation, right? My question is, will you be able to do that?
Yes.
And are you looking to do that?
Yes, just to get back to what I said earlier, I think the game is on return on capital, right? And if you look at, say, some of the other competitors, they've got a very clear asset owning entity within themselves that is then funded by private equity or whatever that may be. And then you've got, so they're very clear opco, propco structures and things like that within entities. Now, would we do that on a here and now basis with where we are? I think we've got our hands full with respect to spending the money that we have, right, and the debt that we're able to get, right, in a judicious manner to grow using the revenue share model, right, across the board. Does one necessarily need to, acquire and own the asset? Well, you're not valuing me for the underlying land value, right? So I think our focus being return on capital and EBITDA growth.
You just to add to that, what Arjun said is that you also talked about data. Just to inform, we obviously are launching a revamped loyalty program. So if you have over 100 plus hotels in the system, the data is going to be very valuable, and that is going to be one of the key assets we will build. Not only the fact that we are populated across the country, but also having that data. So that is going to be a key aspect. And yeah, I don't think, while we look at what the competitors do, etc., I think we have, while we originally, in our original days, started off as an asset-heavy company, we took a conscious call of being asset-light. And I think that has helped the ROCs in a very good way, and also helped the resilience of the business model. And I think at this point, we are quite asset-light, where we do have some revenue shares, increasing our top line. And then we do have a good amount of management contracts, which, like I said, increases the resilience. And our core holdings continue the same. So we do have some owned hotels which continue.
Also on the multi-hotel sales side, I didn't get an update on that. If that would just be my last question. I'll come back in the queue.
Yeah, we have been actively looking for a buyer. and as I've been mentioning over the last so many quarters, but we have not yet been able to conclude anything. But the last couple of months, there are at least some inquiries coming in. Just like in the hotel sector in India, there was nobody ready to give a loan to hotel sector. There was nobody ready to invest in the hotel sector. And now suddenly, the last few months, there are a large number of people. In fact, banks are coming to us that, take the money, and interest rates were 16% at one time, have gone down to 9%. And there's plenty of money available without us having to visit the bank. So similarly, the situation is improving. There are inquiries coming in, but exact thing I can't tell you. Like even in our case of our Hawaii hotel transaction, took a long time, but then it did happen because we stuck to our price. We didn't want to sell it at a desperate price, so we are also sticking to our price there. And I think if the moment we get it, it should happen very soon. I can only say that.
Right. Thank you for taking all my questions. I'll come back into the queue.
Thanks, Yash. We'll take the next question from Rajiv. Rajiv, you can go ahead.
Thank you for the opportunity. I just have one question. What are our plans on banqueting side, since that one area we don't seem to be focused on?
See, what we've done is we've identified about 20 hotels in our portfolio where there is large banqueting space and there's a big potential for weddings in those hotels. So we have now started marketing those hotels to the event management companies. We have printed brochures for that. We are putting a separate tab in the website for that. And we are going aggressively on banquets. We have done pretty well as far as weddings are concerned. Our hotels are very good, and we are proud of the food that we serve. You see, in banqueting, food is very important. We are basically our origins are, for good food in hotels and restaurants. So I think that has been a strength for us. I think we'll continue to do that. And this year we are aggressively marketing it. And I think all our hotels, these 20 hotels, will do very well. And we also have a booking software on Metaverse we have, which is also a game changer in the way we take booking, the way we, the offering that we give to our guests also. And we have a unique thing called, honeymoon package, where if somebody has a wedding in one of our hotels, then he gets a free honeymoon in some of our holiday destinations, where we have got a large number today. We have a large number of holiday destinations. We have hill stations, we have got wildlife destinations, we have got beach destinations, we have got heritage properties. So this diverse portfolio of this thing is there. And so we're going to work with the wedding hotels and these holiday destinations to make a very good offering to the customers.
Yeah. Thank you. Thank you.
We'll take the next question from Sarvesh. Sarvesh, you can go ahead, please. Sarvesh Gupta.
Yeah, hi. Sir, if I look into your performance for the quarter as well as for the full year, it seems to be pretty, the growth rates have been much more low compared to the industry and compared to many of your peers who are also listed. So is it, and that is even after adjusting, some of these one-offs that you spoke about, the revenue opportunity loss plus the repair cost. So is it because of the segment that you cater to that is not coming out, or is it because of the mix of business and leisure that you have in your portfolio? So somehow, your portfolio seems to be not firing as much as what we have seen amongst your peers. And I couldn't understand, why it should happen.
There is no really peer comparison, because if you compare any two hotel companies with us, the mix is very, very different. If a company has a large number of owned hotels, and in the upturn of the economy, that give you much more revenue and profits. Like in our hotels also, what they call GLO hotels, joint venture leased and owned hotels. And when there's an upside, then you'll get much more than what you'll get. We have a large number of managed hotels where the upside will come only in small measures. So they can't be really a peer comparison. But as our CFO had mentioned, that if you see ROCE, there we are better than the peers. So that is what is required to be seen also. And not just that, okay, so-and-so hotels have done much better in terms of revenue. If he's got a larger mix of owned hotels, then his revenue growth will be much more than our revenue growth, because ours is largely managed hotels.
In the managed hotel, which is what you have been growing mostly with in the recent times, do you have any inflation-linked contracts, or these are like contracts which will have the same fee for many years?
They are percentage-based contracts, so it's a percentage of top line, percentage of middle line. That's what these management contracts are based on. So, ARR goes up, revenue goes up, then we earn more.
And I think it must be seen that Royal Orchid pre-COVID to post-COVID, the number of hotels has doubled. And the number of hotels we've taken in the last 12 months and the pipeline that's been announced, these hotels take 3, 6, 12 months to get to a level of stability. So income is future and then linked to percentage growth of the revenue. So over the longer course, it adds up.
Understood. And I understood the Mumbai piece, but I think you have also announced a large property in Surat. So what will be the numbers that can flow from there?
That is a managed property. It's a 288 room property, out of which 1/3 is right now operational. So we will be getting the fee only from that. And the owners are targeting that in 6 months' time, they'll add another 90 rooms to the inventory. And in 12 months' time, it'll be totally 288 rooms. So our fee will come out of that. And so there can't be a very significant improvement in the top line. But whatever top line we get from that flows down to the bottom line, because there are no additional costs involved.
Understood, sir. Thank you and all the best.
Thank you. Anybody else who wishes to ask a question may use the option of raise hand. So since there are no further questions, I would request you to give your closing comment.
Thank you very much, all of you, for joining us this afternoon. And this is a good time for us to look forward to a very, very good time in the days to come, with the election being over and a stable government in place. I think things are going to be looking very well. We were just waiting for that. Market was also waiting for that. And I think with our growth in the next 12 months, I would like to see there are really good times to come. And thank you very much for joining us. Look forward to seeing you in the next quarter.
Thank you, sir. And thank you to all the participants for joining on the call. And thank you to the management for giving us the valuable time. This brings us to the end of today's conference call. Thank you so much.
Thank you very much.
Thank you.